Beginner Live Lab. We're broadcasting this both on YouTube and to our private group as well. So this is where we cover some basic concepts for about 30 minutes before we move on to our daily show that we have with our private members. And on the daily show, of course, we answer their questions, and we tend to cover a more usually a more complex concept. First of all, just to remind everybody what we do here over at Algo Factory, okay? So we help people learn how to build trading algorithms. And one thing about trading algorithms, people oftentimes, they have a misconception. They think it's a complex thing, and you have to be a computer coder and a genius with the supercomputer. And, in fact, you don't have to program anything. If you want to build a typical classical trading algorithm, all you have to do is have a trading plan. I'd say just about anybody who is a successful trader, even in the old school way, is using some form of algorithm, and they may not even know it. So as I like to say, tying your shoes is an algorithm. It's just when you have A, B, and C condition line up and you take action D, technically that is an algorithm. Driving to the store is an algorithm. So, don't let the word scare you. Essentially, we're here to help people learn how to trade, and then eventually what they can do is work with a coder and take their trading method and then hard code it if that's what they want to do, and they can go ahead and let that trade for them while they're sleeping. There are some advantages and disadvantages to doing that. I have worked with both hard-coded algorithms and I have worked with manual algorithms, and I find that I spend about as much time on both. However, I think that if one were to refine a hard-coded algorithm, one that actually is, trading for you in that kind of sense that everybody is, oh, wow, this isn't a robot trading for me. If that is well refined, then actually that can be valuable. But it does take time to refine that. And in the meantime, of course, we are in a scenario where we need to actually build the initial algorithm. And so we do help people get the basics for that. So today, I had a question yesterday about pips and what is a pip. And so I thought that I would talk about that today so that people understand that. And so to give a basic understanding, just in a sentence, a pip is like a tradable unit. So in Forex specifically, okay? So before I get into pips, let me just spread this link around over in our Discord. Give me 2 seconds here. Okay. So we'll go over and we'll actually take a look at a Forex chart here. Okay, I'm going to share the screen, and then I'm going to have to actually expand the screen because it might be looking a little small to everybody right now. So let me go ahead and zoom in. Okay, so a pip, if you look at this screen, okay, this is the euro versus the dollar. Okay, so it's a Forex pair. It's the euro in terms of dollars. So right now, as of this moment on the right-hand side, you see this 1.06739. That means that the euro is worth $1.06739.3837. It's constantly moving, except for over the weekend. Forex is a market that it's a 24/5. So it's 24 hours a day, 5 days a week, Monday through Friday. And it actually it cuts off Friday at, I believe, 2 p.m. EST, if that's correct. Actually, I'm sorry, forgive me. I think it's like 4 p.m. EST. And then it comes back on Sunday around about that same time. And then it just continues through the week until the following Friday afternoon. So what Forex does, again, is that this is a market where you are trading currencies, and it's always going to be a leveraged market. So you're always going to be using leverage because, of course, these currencies move at a fraction of a penny. So you have to trade thousands of dollars to make a profit, right? So, trading with leverage is dangerous if you don't know what you're doing. And in fact, just a quick reminder, as you see in the description of, the YouTube description or wherever else you're looking, nothing we say is to be construed as investment advice. Please contact a licensed investment advisor before risking your money on the markets, because trading can be dangerous and it is risky and you can lose your money. Okay, so everything that we say is for educational purposes only, and our opinions are our own and nobody else's. And that includes, or I should say, our opinions exclude any company that we might mention or any individual. Okay, so as I said, right now the euro is now worth $1.06 and some change. So $1.06720 approximately right now. Okay, so let's go ahead and type that out. 1.06720. 06720. Okay. So that's the price right now, more or less. It keeps fluctuating. What is a pip? Well, a pip is we divide this up into a pip is essentially 10,000. I can't even talk today. This is terrible. 10 thousandths of a cent in this case. And that's how it is with USD pairs. Okay. So now if you are looking at other pairs, then pips can actually be a little bit different. But for the most part, you're going to see, especially outside of the exotics, it's going to be these two numbers. Those are your pips, right? So in this case, if the price went up to, say, 1.06780, right? Let's go ahead and just copy this. So if the price rose a few thousandths of a penny to 1.06780, you're now looking at an increase in 6 pips. So 72 to 78 is 6 pips. Okay. So why are pips important in Forex? Well, because in Forex, this goes back. In Forex, you actually have to trade some pretty decent sized money to make any money. Like I said, there's leverage 50 to 1. And you're actually working in lots. Okay, so a lot is going to be, I think, $1 a pip. So let's say, actually, I think it's at $10 a pip. So I'm gonna do this from memory, and then we're gonna verify this online. So I believe a lot equals $10 a pip. So a mini lot is 0.1 lots equals $1 pip, and a micro lot equals 0.01 lots equals 10 cents a pip. Okay, so let's verify that, because it's been a minute since I've had to even deal with pips. I used to trade on MetaTrader, which means that you do have to, measure everything in pips, right? But now I trade on Oanda, which is a U.S. regulated exchange. And again, I'm not necessarily recommending Oanda. It's just where I like to trade. I like that it's regulated. I'm in the U.S., so that is helpful. So be that as it may, let's go over to pips. I'm going to just go to what is a pip in the search. Definition of, okay, what are pips in Forex trading? Investopedia. Okay, it's a great place to go. It's a good backstop. The smallest whole unit price movement that an exchange rate can make based on Forex market convention. Most currency pairs are priced out to 4 decimal places, as we talked about. So it is, a pip is 1/100th of a basis point. So in other words, let's see here. Okay, let's see here. Calculating pip value. Looking for a lot. Okay, it's not talking about lots. So let's go ahead and ask Forex lot. Standard lot, here it is. I'm going to bring up the chat just in case I missed anything here. Okay, so Gigi says, good morning, cowboy and fellow newbies. Pencils are sharpened, thinking caps are on. That's awesome. Ready for class. I love it. A standard lot is the equivalent of 100,000 units of the base currency in a Forex trade. So a standard lot represents that. A mini lot is 10,000 and a micro lot is 1,000. So far, I think I am correct. A 1 pip movement for a standard lot represents a $10 change. Okay, so I did have that right. Okay, so that means that if the price moves 10 pips, you made $100, or as the case they used here, a 50 pip movement means you made $500 with the standard lot. Okay, so I did have that right. And again, I haven't done this in a long time. So again, one lot, they call it a standard lot, is $10 a pip. So let's do a simulated trade here. Okay, let me make this nice and neat for everybody. Okay, so I'm going to put this over here. Let's say that you entered a trade right here and you risked 1 lot and you exited down here, or let's just say you exited right here at right where it is. Well, price went from 1.06883, if you can see it on the far right, down to 1.06698. So let's just make it nice and neat to 693. And that means that price went down 7 pips. You were 7 pips into profit, which means you made $70 on a standard lot. Okay, so the way to understand lots and how to do the math is, okay, there is a position size calculator that just makes this really easy. You don't have to think about it. Over at babypips.com, which is a great resource. Okay, so this is really good. Now, anybody who's been through my courses understands money management. Okay, so, and we'll talk a little bit about that today too, because this whole thing this position size calculator takes the thought out of everything. And if you're trading on Oanda, it does the math for you, so you can just put whatever dollar amount you're comfortable risking, right? So in this case, I do 2% of my entire account as a standard trade, meaning that if I've got a $100,000 account, then the biggest trade I'm going to make is a $2,000 trade, meaning I'm going to risk $2,000, meaning back to our example here, if price had stopped out, if price, instead of going all the way to profit here, if price had gone to stop out, I would lose $2,000 max. Okay, so that's how I roll. All right, I do 2% money management. And again, we'll talk about that in a bit, but just understand my risk percentage is 2%. Okay, my account balance we'll say is 100,000, just to keep the example relevant. And then a stop loss we'll say was 7 pips, right? So I actually, we'll go to the example and actually show what it is. We go from 885, okay, so 1.06883 to 1.07039. So that would be 88, 98. So that's about 15 pips. Ah, man. So I guess I did my profit taking wrong. So 883 to 039 is roughly 15 pips. You know, it's not exact. I can do the math, but it's fine. So stop loss will say 15 pips. Okay. So I got $100,000 account balance. I only want to risk 2% of my entire account at the most. Stop loss is 15 pips. That means that I can risk, obviously, 2,000 like we talked about earlier. So the position size, aka units, is going to be, like let's just say you're trading over it at Oanda and you want to just do units, then you can use that unit amount. But if you're actually, trading lots, if you're doing this in a standard manner, like if you're trading over MetaTrader and you're actually entering lots. Now, it's been like 2 or 3 years since I've used MetaTrader, so perhaps they've updated it. But in this case, you would just do 13 standard lots. So, and that is, a typical way to do a trade on these exchanges. It's going to ask you like how many lots you want. Okay. Now, if you did have a like $1,000 account, and you're going to notice that it's actually 0.13 standard lots. So it's 0.13 lots. It's actually 1.3 mini lots. But just, it's always going to ask you in standard lots what the size of your trade is. I know the screen might be a little bit small. Wow, it's only zoomed in 100. Okay. Sorry, for anybody who couldn't see this, we'll go over that example again. So if my account balance was 100,000, okay, and I'm risking 2%, I got 15 pips. I'm going to calculate, it's 13 standard lots, okay? So now on Oanda, I can just type in $2,000 and it'll do the lot calculation for me. But on MetaTrader, last time I used it, I would actually have to put in 13 lots. Now there's, mini lots, micro lots. That's fine. Most of the time it's just going to ask you in lots. It's just, I don't know why this puts that there, but maybe there are some exchanges that will want to know in many lots, but in this case, it's a standard lot. And then again, if you have a $1,000 account balance, you're risking 2%. That means if you stop out, you are only going to lose $20. And it's the same exact trade with a 15 pip to your stop loss. Do a calculation, and now you would be putting in 0.1333 standard lots to manage your money that way. Okay, so that being the case, I don't see any questions here. Yeah, Gigi, so that's a good question. So pip values, what'll happen is they will fluctuate in a sense. Okay, so look to the top left of the screen right here. You see that? So you see the 1.0668 and then you have the little 8. Well, wherever the big numbers end, that is your pips, right? So for most US pairs, it's going to look like that. For most pairs in general, it's going to look like that. But you have the odd pair, like for example, the dollar yen, where it looks a little different. It's the same up here on the left corner conceptually, right? But it's not going to 4 decimal places. It's going to 2 decimal places because the yen is, in a sense, so much smaller units than a dollar, right? So it's not like a euro where it's, close to 1-to-1, or say like a Swiss franc. It's more, it's like 139 yen to the dollar instead of like 1.39 yen. So your pips are going to be a little different. And if you look here, I'll just type this out to make it easier to see. 1.3980 or 139.07, right? So let me blow this up a little bit. All right, so your pip is actually different on this pair. It's actually going to be this. It's not 4 decimal places. It's 2. It's actually 1 and 2 decimal places. So, the single pip being like this second decimal place. So if price were to go up to say 1.39827, then price has actually moved up 2 pips in this case. So, you got to know your pairs. Within the major pairs, I think this is the only example where a pip is not that 4th decimal place. And it's something that as you're trading, you're definitely going to get to know it, because you, especially if you're on a place like Oanda that just does all the math for you, you can't really mess that up too easily. So But that's how a pip works, right? So, and there are people, I know people who actually, yeah, okay, so Truck Face pointed out exactly what I was saying. Um, it's the only major pair, right, that has the that different, excuse the yawn there, that different kind of configuration. So there are other pairs. If you start getting into the exotics, you start trading. I'm not sure. I don't know, the Turkish lira. Stuff that you just doesn't have a lot of liquidity. The pesos. I imagine those have some different decimal aspects to them. But in the end, if you ever need to know, like let's remove the drawings and go to USD MXN. I think a peso has been, I don't know, like a tenth of a dollar, more or less, for a long time. More or less, at least on that order of magnitude, right? So in this case, your pip is going to be out at that fourth decimal point. Even though the peso is like a tenth of a dollar, if you look at it, it's 17.48187. And the 7, if you look to the top left, that 7 is a little, right, well, now it's a 9, but the 1, 2, 3, the fifth digit up here is going to be the smaller number, meaning that your pip is the number before that. So in this case, at the time that I typed this, that 7 on the 187 was the smaller number. So your pips are the 18s. Okay. So that's how you know the pips according to the chart. Now you look here and you notice that this spread is like 45, 50 pips. So the spread is significant, but again, you just have to understand that if you're going to trade this, you're going to trade an illiquid pair. Like for example, any exotic is going to be illiquid. Like go to like the Swedish krona. So the euro, Swedish krona, or even better, the Norwegian krone versus the Swedish krona. It's only, it's the same kind of decimal point system, but the pip is 17 spreads. I mean, the spread is 17 pips. So there's not a lot of liquidity. Okay, so this conversation that we had yesterday about like market orders, this is where that comes into play. So let's say you want to go long right here, right? Your stop loss is like down here. Well, if you set your price on a limit order, then price has to make its way down there. The middle of the candle is here, but this red line on the top is actually the top of the spread. So that top of that spread has to come down to this area in order to actually meet that price. So unless you market order, you won't get into this. But if you market order, you have a 1.4 risk to reward that's instantly going to change to a 0.9 because you go to the top of the spread there. So that's something to understand about spreads and illiquid pairs. You either have to account for the spread when you enter the trade, which really, it just helps to trade in a higher time frame with those. Exotics, I think, should almost always be on like a daily time frame, because the spread is going to effectively be smaller, right, when you're on a higher time frame. It's not really going to change, but because you're trading bigger moves, then the spread is going to matter less in a sense, right? It's going to proportionally be smaller to your trade. So that's outside of what we're really talking about, which is pips. But understand that the spread represented in this number in between the asks and the bids, that spread is 17 pips. And so just a reminder, like the bids and the asks, that is, remember, this is you got to go back to the video and look yesterday to know what a bid and an ask is, right? And I'm talking about, I even put like a quick clip up on YouTube, or if you just look at yesterday's like YouTube, beginner show, you'll see bids and asks. So when you have a high spread and you do a market order, you're going to have to go a lot higher to find somebody who's willing to sell you what you're buying. Or if you're trying to sell and you want to do a market order and there's not a lot of liquidity, there's a big spread, you're going to have to go a lot lower to find somebody who's willing to to buy what you're selling. If I were to draw a line right now, okay, so those two lines are like where the spread is, right? So if you want to buy right now, this, okay, sure, the candle's sitting at this 97894, but if you hit the market buy, the spread, the only person who is selling anything is way up here at 97975. So instantly, your entry is not going to be where the candle is. It's going to be way up here where the spread is. Now, let's say you want to get out of the trade, right? Well, if you want to get out of the trade, that's fine. Sure, the candle's right here because it's in the middle of the spread. But because nobody is buying anything way up where you are, the next person who's willing to buy anything is down at 97802, which is where this line is right here. So if you hit the sell order, it's just going to sell to this person way down here because nobody's buying up where you are, because the candle's halfway between the spread and it's a very wide spread. The only sellers are selling way up here. The only buyers buying way down here. Okay, so that's how a spread works. And that's why I don't tend to trade these exotics. They're just, they'd move too slow for me. It's not my personality to trade something and then come back 3 weeks later and look for a take profit. So that's, and that just has to do with my preferences, but there's people who make entire careers out of trading exotics. One of the issues with trading exotics, though, is that, if you are trying to mess around on lower time frames, you have these nasty wicks because of the illiquidity. So you can see that. So a quick blurb on money management. I think that it's like one of the first and most important classes that's over at algofactory.tech. Let me go ahead and actually type in the web address for algofactory.tech. And I'll put it in the comments. It's also on the YouTube. If you just go over to the YouTube page, you can click on the website. It's an easy way to do it, but it's www.algofactory.tech. So, hop over there, take a look at what we're offering. We have a pretty comprehensive course that talks about the most important things, in my opinion, when it comes to learning how to trade. The trick with trading is that it is such a broad subject with so many different methods. If I were to make a beginner video on every single subject and question, to be like 1,000 videos in the beginner course. I think it's called the essentials course, actually. So, what I've done is I put in what I thought was just the necessary bit. So you're not going through, 5 months worth of beginner courses. And you'll go ahead, and if you watch these live shows, and if not this live show is the beginner live show, but the private group live show that we do every day, we start right about now. We actually start at 9 o'clock a.m. EST. We go through the market open until, 10 EST, right? And as we go through that, it's going to kind of fill in a lot of information. And we do actually keep those, and we keep like a month backlog of those, so people can actually go look at those who were not able to make the live session. People can ask questions. We have a Telegram where you can ask questions 24/7. You'd be like, hey, I was watching a live video. I saw this. Can you answer that question? We're in there all the time. I'm answering questions like at midnight, my time. So come on over to algofactory.tech. It's $49.99 a month. And so basically, this is such a cheap price. That price will go up, but those who are able to kind of join in and hold on to that price, when the price goes up, you'll actually be able to keep that price. So if we double the price in 2 or 3 months, I'm not saying we will, it's going to happen soon. It might even be more than doubled. But whenever that happens, those who came in at $49.99 for that tier of service will be able to keep that tier of service. So, again, smash the like button. If you're watching this on YouTube, we can definitely use the help on the algorithm. It's a newer channel. So, that's something we can really use some help with. Spread the word, if you will. We also have an affiliate program. So, if you really like what we're doing and you maybe have an audience, then each person who comes in using your affiliate link is going to pay you every single month that they stay with us. It's not a one-time thing, so it's good income from that too. We hope to see you soon. www.algofactory.tech. Again, if you're on YouTube, all the websites, social media, it's all on there. We hope to see you again soon.